Alright, today we're going to go over all the ins and outs on butterflies, what you need to do them, how they work, and how to set them up. I'm only going to use tastytrade as a broker to show it on. It's going to be very similar on every other broker, just because the way you set it up is the same no matter what broker you're using. It's just that once you learn the actual setup and the how the trade works, it's all the same. It doesn't matter because you can do it without doing like a custom tool like Tastyworks does, or you can do it with a custom tool. With most brokers, they just allow a button that says click butterfly, and then you can adjust it however you want. So, but first and foremost, in order to do butterflies, you need to have a margin account. And this scares a lot of people. And I don't know why, because just because you have a margin account does not mean that you're actually using margin. You're not going to lose more than you put in. And I pulled up tastytrade's margin. This is their margin page and like how the margin interest works. And it specifically says in the very first sentence, when you're on margin, it means that you're borrowing money to hold security positions. Options are non-marginable, meaning you cannot buy options on margin. So that's why, but you always have to have a margin account to do spreads. Why? I don't know. That's what their rules are. You have to have a margin account to do spreads. This is a spread trade. And so even though you are on a margin account, you will not lose more than you put in. I want that to be the biggest thing because people are scared to apply for margin account thinking they're going to be using margin. Just because you're on a margin account does not mean you are using margin. And so next we're going to go into how to set up a butterfly. Once you get your margin account, you do have to apply for a level 3 options account. That's in order to do spreads, you always need a level 3. Tastyworks just has a margin account called The Works. It's automatic level 3. A lot of other accounts like TOS, Robinhood, you actually have to apply for it, do like some sort of survey. Usually you have to finesse them a little bit and kind of lie and like be like, "Oh yeah, I've done it for a long time. I'm super good at it," and they'll just let you do it right away. So now I'm going to go on to Tasty and I'm going to show how to actually set up a butterfly. So once you get your level 3 setup and you're able to do your butterflies, you type in whatever symbol you want. I'm just going to use SPY, SPY as the example because it's the one I use the most. You can do any expiration. So you're going to pop up your options chain. You can do any of these expirations. Lately, what's been fun to me because they move so fast are these 1 day or 0 day expirations. Of course, obviously, because they're so close in expiration, they are more risky because if you get a good gap down or a good gap up, then it's gonna really mess with you. And we saw that on a couple days ago. We got clapped from the gap up on Facebook, and it just kept running, and our butterflies didn't do nothing. They were just worthless. So to set these up, what it is the very basics is a call debit spread mixed with a call credit spread. But the call credit spread is at the short strike, so that's your sell to open, is at the same spot as your long as with your debit spread. Hold on, I don't know why that messed it up and did 2 instead of 1. So there's your call debit spread, and then you add a second one on the short leg. That is your short leg, your sell to open, and then you add 1. Now that's a call credit spread. So here's a credit spread is you sell 1 to open, and then you buy 1 further out. And then you sell 1 to open and buy 1 further out is your further in the money is your debit spread. So this brings it to gives it a little range. I need to go to the next because it's gonna fuck it up with mine. Because I already have a trade on in this next expiration cycle, it's not showing it correctly. So here's then this green box right here. This is your profit margin. So notice it's at a range right here. And why is this called a butterfly is because you have two of your short strikes, your red, that's your sell to open. That is your body of your butterfly. And then it's called a butterfly because the wings, your buy to open, are equal distances. So right now I have them two, and they can be any wide or short as you want. So generally what I've been doing is I've been doing $3 wide butterflies because that usually gives the best risk to reward. As you go further out and as you widen your butterflies, you get a less risk to reward. So notice we'll go here, bring this to a $1 wide. You got about a 10 to 1 risk to reward, but your probability of profit is very low. See right here, Tastyworks has a probability of profit. Some of the other brokers do not. I don't know about it, how the other brokers work with your pop. It makes it easy for Tastyworks. They so their probability of profit with a wider spread tends to be a lot higher than your probability of profit with your shorter spread. So notice how we went from a $1 wide, and I call them wide because that's how far they are. So $1 wide would be $1 apart for the strikes, $2 wide, $2 apart, so on and so forth. And so notice as I'm bringing these out wider and wider, your probability of profit is going up each time. And so every time I'm at a $4 wide, I'm roughly 40% probability of 50% max profits, 51% probability of profit total. But as you notice, before when we had a $1 wide butterfly, that was a 10 to 1. Now we are under a 2 to 1 risk to reward at a $4 wide right here. So we're seeing this is costing $139 and this is profiting $261 max profit. So how do you figure out this max profit? So the max profit calculation is the distance of the strikes. So right now we have $4 wide minus the amount paid, the debit amount paid, equals your max profit. So that's going to be $104 wide, 1, 2, 3, 4, minus, so 4.00 minus 1.39 equals 2.61. So that's going to be your max profit. Generally, I try to stay within a 2 to 1 very, very minimum risk to reward. And that's a lot of because it's kind of a higher probability of profit. We're able to get profits more often. So I don't mind getting the 2 to 1 risk to reward. So like right here, we have a $3 wide. $3 wide risk to reward, 40% probability of 50% profits, and then a just about a 3 to 1 risk to reward. And that's ideally what I'd like to see. Risk 81 to make $219. That's perfect. So now how are these profiting? These are theta positive, and so you kind of have to understand your Greeks now with some of these. So if you don't know your Greeks, it's a little harder. So we go back through and go over your Greek. So what theta is, so theta decay is how much you gain or lose by holding that contract every single day. And so a positive theta means you gain profits from holding that contract every single day. A negative theta would mean like when you have a single leg option, see it's a negative theta. That means you are losing, the contract is losing profit losing that much every single day you are holding this profit. You're holding this contract. So that's why butterflies are good because they do have a positive theta and you can adjust the deltas a little bit, which we'll go over in a little bit. And so they have a positive theta. And so right now this is for a 2-day, this is a 6.11 positive theta. So you gain $6 for every day you're holding this. So that's why a lot of times you see when we do our 0-day options or our next day options, immediately if we don't see a gap up, we're seeing 10%, 15% profits right away because of that theta decay. And that's what's giving us those profits. And so then the next thing we do have, which I don't have a way to do this to show how, but we have a negative vega. So you see, if you multiply your vega amounts, zero point 0.2 times, so this column right here is vega, 0.2 times 2, that's zero point 0.4, minus 0.32, that is 0.08. So you do have a positive vega. What does that mean? That means that every time volatility contracts, you are gaining money on this. So your IV crush, you're gaining money from the IV crush because you have a positive vega. And I've noticed that when SPY so notice SPY's IV is at 12 right now, which is absolutely super fucking low. It's a minus 5.3 IV rank. When you have a higher IV, you actually pay less for your contracts, for your butterflies, because you're collecting more with your short strikes. So you're going to be collecting more from the at the money premium, and you're not going to be selling quite as much, buying quite as much for your insurance on the out the money, and the in the money call and put. And so you're gonna actually get a you get that positive vega, and since that is, and then you collect from the Ivy Crush. They're very good for earnings trades that go sideways. Butterflies are very good for, but we did notice for our Facebook earnings trade, that lotto I did, it does have a defined risk on both sides. And so if it goes too far, like Facebook did with ours, you end up with 100% loss anyway. So even if there is an IV crush, if it goes past your wings and you're past your break even, you do end up losing. So what is your break even? How do you lose on this trade? You lose on this trade not by the price going below your long strikes, but it's actually below your break even. So how do you calculate that? Your break even is the price, your max profit price, plus or minus, plus and minus your short strike. So 2.14, so 214 is your max profit. In options, that's 2.14. Everything is divided by 100 because options are worth 100 shares. Um, so 2.14 plus 16, 2.14 minus 16. That is going to be your profit. That is going to be your break even on these. So, uh, so it's 413.94, I think. Doesn't show the exact, and I'm not going to go through the math exact to do it. And then 416.14. So you notice that's $2.14 subtracted by the 416 gets you your break even on the downside. $2.14 plus 216 would get you your break even on the top side, so 418.14 on the top side. And so that's where you're going to get your start losing on that. Anything past that, you're going to lose. And then past your short strikes right here, or your long strikes, that is where you get your max loss. And so your max loss is the amount that debit you pay. Luckily, there are other strategies where you have infinite max loss, but that's not what we're doing with butterflies. Butterflies are good because they are defined risk. And so past your long strikes, that's where you're getting to into your max loss territory. So like we saw the other day, if we see a huge gap up, then you can that's why they're always in high risk, because I always say if you get a gap up and it just runs and it runs past your long strike, runs past your break even, and it just doesn't look back, you're just fucked. There's not You have to be really quick with it, and a lot of times what we can do is just have like a 50% 50% loss rule where you cut your losses at 50% and move on to the next one with our profit with our probability and the percentage success rate. That works because our average probability of profit is about 60%, 66%, which it seems like it's not a lot if you cut at 50%, but if you're only losing 2 or 4 out of 20 trades, then you're still making a hell of a lot more than you're actually losing. Um, and so that's where it goes to like how are you going to manage these trades? I like to manage at 50% profits. When I hit 50% profits, I'm taking half off almost every time. And unless it's just a really really slow day and you just kind of know that's like okay, it's going to be a range day, I don't see it really breaking, and then you can kind of it's in context of course just like everything else. The last few weeks have been really good because if you're with earnings before those earnings, sometimes you don't get heavy moves, so you're able to hold them a little longer. With a further dated, so when you go out in time farther and you get, say, a 21 days till expiration, gamma starts kicking in 21 days till expiration. Gamma and theta start kicking in harder when you get these further expirations. And so I usually try to manage these. I try to take most of them off at 50% max profits, and that way you don't have, because it's going to fluctuate a lot more as you get further in, and you can't necessarily look to see where, you can't guarantee it's going to stay in one spot for that long, especially with an asset like SPY. Oh, so that also goes into after after if you are on a short dated option, so like our 0 days or 1 days that we're doing, on a 0 day, gamma risk is the amount that your option is moving with your delta. So when SPY goes against you or with you, how much is your option going to move? Generally, when you have a 0 day, you have about a 26% gamma risk, which is mediocre. You have a lot higher of a gamma risk with naked options, obviously. That's why they move so much more. So when you have a 26 gamma risk and you have that for the first 2/3 of the day, and then after, so that would be if you split up the day into three parts, that's 2 hours and 10 minutes each portion, 6.5 hours throughout the whole day. You get about a 23 to 26% gamma risk the first two thirds of the day. After the last third of the day, you actually bumps up to a 50% gamma risk, which is 2 times the amount. And that actually happened in a trade of mine, a couple, not last week, but the week before, is we were at about 80% profits, and then we hit right after lunch. And so to the last third of the day is at 2:50 p.m. Eastern Time. So uh 11:50 Pacific Time. That's what time I'm on. Right after lunch. Right before right after lunch, right or 10:50 Pacific Time in 2:50 Eastern Time. So it's um right before lunch ends. That's when that starts. And so I noticed one day I was at 50, 60% profits, and then the market moved away from my short strike just by about 50 cents. Not a ton, but it destroyed my premium and brought me back to break even because I was on that last third of the day, and gamma is affects it so much more. So when it goes away from your premium and your short strike, the contracts move a lot more. That's why you see when you do like SPX or SPY 0 days, they move crazy the last hour, 2 hours of the day because they do because of that gamma risk. And so I always look to cut my 0 days before lunch is finished because that way you have as much control. You don't have twice as much risk and you're de-risking before your options Greeks actually start going against you. So then what types of environments are these working best in? So if we go back to SPY and we go on a daily chart, actually this weekly looks perfect, but this daily right here, and Tasty Trades charts kind of suck, but this small range, that's really what's best in it. You're going to get a smaller risk to reward, but if you can guarantee that it's going to be a not a very big range, you can skew your options and these butterflies to make it to where you can almost get the whole range that they have and be profitable within your whole daily range that you expect. And one way I do that is I will use, so if you go on the right hand side of your chart of your options chains, I know Thinkorswim does this, has this as well. I do not know about Webull. I don't know about Robinhood. I don't know about fucking E-Trade. I just know Thinkorswim and Tastyworks has this component, is where it says right here on the next to the volume right here where it says IV and then it says 10.7 and then it has parentheses plus or minus 2.03. That is the expected move to that expiration date. And so it's expected to have a $2.03 move up or down. You can kind of use that to your advantage with your butterflies and make it to where, okay, I'm going to make sure that I am I'm profitable throughout this whole expected move or most of the expected move if you're following strictly that minimum 2 to 1 risk to reward that I was talking about. And so if you see here a $3 wide, and that's why I like these $3 wides because SPY's expected move is usually $2 to $5. And so you can see this green is where you profit, and the orange, Tasty Trade makes it easy. This orange is the expected move, that plus 2.04 right here. And so you can see that we're profiting almost throughout this whole expected move. So if it's a range day and we're just up two down, up $2, down $2, up $2, down $2, up $2, down $2, we're staying in our expected move and we're going to stay profitable throughout the whole thing. Your max profit, your sweet spot, is going to be right at this short strike, right at your 416. And then it kind of goes a little, and then as it goes away from it, you get less and less. You can also skew your butterflies based off of what direction, like if you have a bias, you can move them over, up and down. Oh, I just had one. So like say you think tomorrow is going to go to 418, you can shoot a 418 butterfly and that's going to have a little bit bigger risk, a little bit better risk to reward than say, oh, hold on. I got to go put. It doesn't matter if it's a put or a call butterfly. They always are they always are they always are priced the same because you're selling one, buying another, and buying the other. Doesn't matter whether you do put or call. I just have to. I'm just like right now because I actually have positions on this SPY. I have to move it over to put. And so see if you say you think it's going to go to 418 and go to the top of our expected move range, then you can adjust that a little bit and notice how it doesn't cost nearly as much as just having this, oops, 418, 421, 415, $1, 416, 419, 413, 118. That's 20% more. And so it is a little cheaper if you do have a bias and you do expect it to go a specific way. But every gimme has a gotcha. If you do that and it does not go the way you think it does, or if it just goes sideways all day, then you end up losing a lot faster because it's not going towards your short strike. And so that's where you can actually kind of layer some of it's a little more something I've been testing and it's a little more advanced, but you can layer your butterflies to where um, to where you can get a wider range in your trade. So like these are the positions I have on right now. So this is the one I called out. No, this is not the one I called out. This is just an insurance one I had. Let's go to the one I called out. The one I called out was a 415, 418, 412. So this is our profit range for Monday. If it stays around 416, 415, that's our sweet spot. If it goes up a little bit, then that's where we start losing if it stays on 415. But let's say you skew it a little bit and you add a 416, 419, 413. See, now you have your sweet spot is a range 2 now, and your profit and loss are adjusted and even further. You don't get quite the same risk to reward where now you're actually risking one to make one almost, but you have a lot higher of a you have a lot higher probability of profit because you have a wider range, and then you can adjust it more. Say if you want an insurance, then if you think it's going to go down, boom, you can adjust that as well. You can add on a further out onto the downside or further out to the upside on either way. And so that's where you can really use these to make a larger range, but a smaller probability, smaller profit margin for the amount that you have. So I always recommend when you start, just do just one and skew it towards your bias for that day. So like if you think it's bullish for the next day or for that month, you can kind of skew it even if it's just $1 out the money. If price is at, let's say if price is at 415.50, you either have to do a 415 strike, you either have to sell the 415 or you got to sell the 416. If you have a bullish bias, just go ahead and sell the 416. You're more likely to hit that if you think it's going to continue up or go sideways on that. Um, these are a little, they're a lot, the further out in date you go, they get way cheaper, but they're not going to go, so like say you think it's going to go to 420 in the next 20 days, you can widen them out and get get a larger profit target for the same. So now you have a 4-to-1 risk to reward and a huge, so now as long as it goes up from where it's at right now, you're going to be profitable on this trade. If it goes up from now to the May 19th, you're going to be profitable on this trade. So let's take out all these other ones that I have. Let's take out all these other ones and just do these three. So now at expiration, as it expires, as it gets closer to expiration, the more it goes up and the more it stays in this towards your 420, you can go up. But it's still a negative delta even though you're wanting it to go up, which is kind of good because you don't necessarily want a heavy positive delta because then it kind of uses more of theta and vega than the delta moves, which is great. So like if you notice here, it says it has a 98% chance of getting 50% probability of profit. That's a theoretical chance of getting 50% probability of profit. And then you can also, and this is where it gets a little more fancy and a little more advanced. You can skew your butterflies. So this is what's called a broken wing butterfly. So normally you have them at the equal distance, like I was saying, $3 wide each, $5 wide each. But if you adjust them to make one side wider than the other, this is called a broken wing butterfly. So this makes it to where you're actually collecting what you're trying to make it do is you're selling, so your credit spread portion is you're collecting more than your debit spread portion. So you have a $5 wide put credit spread essentially, selling the 410, buying the 405. And then you have a $2 wide debit spread, put debit spread, buying the 412 and selling the 410. This gives you a credit that you're collecting, still a positive theta, but it gives you a skewed delta because you have a higher amount of short puts that you are selling. Your max profit is still at this 410 level, But if it doesn't happen to come that low and it just stays above it, you profit the amount you collect or whatever you want, the difference between what you collect and what the premium is. And so if you look here, let me zoom in on this a little bit. You have from 407 up, you're profiting. So 410 is your sweet spot, but as long as if you do have a bullish bias, but you think, oh, it might pull back, but I do think it's going to stay above this level, then you can shoot for whatever level you think it could pull back to, and then anything above that, you're profiting. Similar to a credit spread, but it gives you insurance on the downside if it starts to go below you, if it starts to go against you closer to your expiration. So this is something where you're only going to profit for this larger portion at your expiration. It's actually a bullish position where you want it to go up. You want to collect the amount of credit you're collecting more than, oh, if it goes against me and it goes the other way, you're going to be down at your theoretical profits is going to be in the negative throughout the duration of the trade until the end of the trade as it's closer to your short closer to your short put. So if it is. But it takes a lot more buying power. That's why it's not something I do a ton. But you can do it to where, say you do a general Tasty trade 45 days till expiration, Broken Wing Butterfly, you can get a decent amount still. So if you do that same 405, 401, 402, sell two of these, you're collecting 60 cents. So your max profit, if it's above 412, is 60 cents. So if it stays above 412 from now and June, or just continues to go up because you have that positive delta, then you collect that 60 cents and that's going to be your max profit. But if it goes below and gets between 410 and 405, 412 and 405, you're going to get more profits. But your risk to reward isn't quite as good. You're charging more because you have to pay the difference from your short strike first. So you're always going to be paying more than what you're collecting, and it's usually about I would try to get about a 1-to-1 with your buying power effect to your max profit. But your probability of actually hitting that max profit is very, very low. So you have, let's see, what's the delta of this? 38 delta. So you have a total of a 38% chance of it actually hitting this 410 at expiration. For those that don't know, your delta is the amount that is that 38 or 58? 58. Sorry. No, 58 is a vega. 38 is a delta. So yeah, for those that don't know, your delta is also the theoretical probability of profit of your strike being in the money at expiration. So that's just a little more on the Greeks. I can do a full class on Greeks and more advanced options and things like this, and throughout and this later as well. So that's something that we can go over. For those that don't know Greeks, I highly recommend. Greeks are very, very important, especially when it comes to advanced options. Because you're trading more for the Greeks than you are for the actual trade a lot of times. It's probabilities more. So if you notice here, we have a 90% probability of hitting 50% max profit. So 50% of your credit collected. So $30 essentially. A 90% probability of making that $30 and a 63% probability of getting anything at expiration. And so that's where it does have a lot higher probability of profit than a normal butterfly, but you're not quite, the risk reward isn't as much, and your probability of actually doing what you would want to use a butterfly for, and that's hitting your short strike, is a lot lower because you're going out of the money as opposed to when your basic butterfly is at the money. When you ask somebody, hey, what am I doing for a butterfly? What is a butterfly? They're going to tell you an at the money, sell two at the monies, buy one out the money, buy one in the money. That's just your basic butterfly. And that's where when you do the broken wing butterfly, in my opinion, it kind of gets rid of your butterfly that you really are actually trying to do. So like let's say, and this is actually a really good one as well in my opinion. Say you have a big range for SPY and you think it's gonna go no more than 430, no more than 400, no less than 400 or so, then this is still a 3 to 1 risk to reward, a 4 to 1 risk to reward almost. For June, it's costing $386, but you got a $15 wide butterfly. So, whoops, spread. I can't even spread it, zoom out that far. There it goes. This thing's wonky. Oh, fucking A. It always does this to me. There we go. So see how far you have your profit ranges from 405 to 425 essentially. Let's round it to make it easy. And you have a 31% chance of it staying within this profit range. And that's a super good probability of profit in my opinion because you still have that positive theta. You're collecting $2 in premium every day that you hold this, which is about 1% of the contract. It's a little under 1% of what the contract's worth. And that's where if you get your short dated options, you notice that was a 1 theta. These short dated options right here, you can really collect some theta. And so if you think it's going to be a choppy day, or you think there's going to be no gap down, it's going to be just hanging out, you have a 6 theta. So that's 6 times the amount of theta that you're collecting. So let's say you have 5 of these, or even just 3 of the, yeah, let's say you have 4 of these now. You're collecting $25 in theta right off the bat. And so a 6 theta, that's 5%. That's almost exactly 5% of your contract just from theta. And that's where the theta value really helps when with these short dated ones, because when there's no gap down, no gap up, we really collect that theta. We really collect the extra premium and it gets built onto it. So those are really the ins and outs of butterflies. You're collecting more as it's just staying in your range. If it doesn't move, you're happy. If it moves a little bit, that's okay. If it moves a lot and out of your strikes, then that's where you really want to manage and just either decide, okay, do I think it's going to come back, or do I just need to get the heck out? Your butterflies they move the most as they get closer to expiration. And so as you have to hold them longer if you have longer dated strikes, you have to hold them within this 21 days till expiration, usually more than you would um a normal normal theta trade, because normally I don't, like, if I'm selling premium like just a naked strangle or a iron condor or something, you're cutting it at 21 days till expiration. You're cutting it at 50% max profits, with these tasty mechanics that I can go over in the future. And so with butterflies, you have to hold them closer within 7 days, usually till expiration. Um, I messed around with a May 5th butterfly and just did to the downside, and that was when we were going down the other day. And they do move decent when you when you skew it, where you're going to use a specific a directional instead of just doing a neutral range. So like say you think it's going to go a little lower, you can bring it down to a 405, do $5 wide instead of your $3 wide, and still collect. This is about a 10 to 1 risk to reward.
So your risk to reward on these can be incredible if you have the right direction and the right time. And that's the key, and that's why they're so hard, is because, and that's why they're so hard for longer dated, in my opinion, and for at all sometimes, is you don't exactly know if it's going to be in a range, if it's going to be in a specific direction, or if it's going to reverse. And that's, I'm not doing them on earnings anymore. We got absolutely destroyed from Facebook earnings. And so that's where I'm just, don't do them for earnings, don't do them before FOMC, obviously. Maybe the day before FOMC, because if FOMC goes so sideways throughout the day until 11 o'clock is usually when they do, 11 o'clock my time, so 2 o'clock Pacific time or Eastern time, then you could do them the day before FOMC and just cut it before FOMC. And if you don't think it's going to have a gap up or down, which usually it doesn't, and it usually has about a $1 or $2 range the day before FOMC, you could hit a butterfly, cut it off before FOMC, and you're solid. But earnings where you have like a Facebook earnings or an Apple earnings or a Amazon earnings, which can move the market 3, 4 points, and that can be out of your directional range because usually if you have a $3 wide butterfly, your only your only max profit is 2 points, $2, which is means you only have a 2 point range. And so you have to be very specific sometimes with the days that you do them. And that's why I very, very preach stay small. Stay small, stay small, stay small. Do not put more than 1% of your portfolio in these trades per trade. You do not want to take a big loss on them. They are high risk. That is why I put them in high risk every single day. Even though they have a pretty decent success rate, you can get they can go against you very, very, very fast. And if they start going against you, if the market keeps going, they just go even faster because they're your short strikes at short dated options, your short strikes are you're getting destroyed with a lot of these. And so that's why I highly, highly recommend do not put more than 1% of your account in these trades. They are high risk. They can go they can go against you really fucking fast. But that's the basics. Then to recap one more time, you sell one, you sell two, and you buy one. And so that's the main takeaway. So sell two at the money or around the money, buy one in the money, buy one out the money. They are equal distance, generally, for the most part. If you're doing just normal butterflies, they are equal distance apart. So your wings are equal distance apart. So 415 plus 3, 418, minus 3, 412. So those are going to be, that's kind of my bread and butter setup. 12:30, 12:30 p.m. my time, so that's 3:30 p.m. Eastern time. You're looking to see what around the price is it doing. Am I thinking it's going to go up tomorrow? Am I thinking it's going to go down tomorrow? Am I thinking it's going to be neutral tomorrow? So if you think it's up, if it's 415.50 and you think it's up, you go up one, maybe two if you're feeling risky. If you think it's going down, you can go down one or two if you're feeling risky. Like I said before, if you do go further than 1 point out of the money and it doesn't go to the way you want it to go, then you have a lot higher chance of kind of it's going to be harder to get your money back and kind of bring it back to you. But that's why I try to stay within that $1 in and out of the money. And so definitely like that's the key takeaway. And then before, so if you do 0 days like I do a lot or next day options, I'm putting them on at 12:30 and then I'm taking them off by it's 10 so it's 11 o'clock my time usually the next day. So 2 p.m. market time the next day. So 3:30 p.m. one day to 2 p.m. the next day. That's all I'm holding these a lot of these 0 days. What I'm what I'm kind of back testing and going through is if you have like a heavy orb, like a opening range break that we see that Scorpions taught and that we've done a lot. If you do have a heavy orb and it goes in one way and you see it's gonna be a trending day, you can take these off quicker because if you have them at the money, take them off quicker if you're expecting that range day to continue so you don't it doesn't like if it's close to your if you have a little profits even 20 to 30% profits, it's close to your strikes, it's in your sweet spot, but you're looking at the charts and you're saying it's not going to stay in my sweet spot, don't be greedy, take that shit off, it will go against you so fast. So if there's any questions, I'm going to open the mics up and allow anybody to ask questions. I'm going to stop streaming recording right here as well.